Dear viewers, hopefully all of you are doing very well. I'm Dr. Sharat Khandoka, and today I will talk about lease finance. First, the learning objectives. So the learning objective includes 1. Define a lease and specify the rights and obligations of each party to the lease. 2. Distinguish between a sale-type lease, a direct lease, and a sale-leaseback. 3. Compute the cost of leasing in a perfect market. 4. Define the 4 types of options available for the leasee to obtain ownership of the asset at the end of the lease. 5. Distinguish between the two broad categories of lease recognized by the IRS. 7 is describe the treatment of lease in bankruptcy. 8. Given necessary input, compare the cost of leasing with the cost of financing. And the last one is identify good reasons for leasing, including for a non-tax lease. So the basis of leasing. So the first slide will talk about the definitions of different parties of lease finance. Number 1 is the leasee. So the leasee is the party in a lease liable for periodic payment in exchange for the right to use the asset. So the leasee is basically who is actually leasing the asset and paying a periodic payment for utilizing that asset. Second is the leaser. The leaser is the party in a lease who is entitled to the lease payments in exchange for lending the asset. So the leaser is basically the owner of the asset. So he is actually lending the asset to the leasee, and because of he's not using his asset, he is charging some payment. So most lease involve little or no upfront payment. So the leasee commit to make regular lease payment for the term of the contract, and at the time of the contract term, the lease specify who will retain the ownership of the asset and what are the terms. Now in this slide, there are some examples of lease transactions. Number 1 is called a sale type lease. So sale type lease is a lease in which the leaser is the manufacturer or the primary dealer of an asset. For example, IBM both manufacturer and leaser of the asset. The direct lease is a type of lease in which the leaser is not the manufacturer, but it is often an independent company that is specialized in purchasing assets and leasing them to customers. For example, Ryder System USA owns more than 135,000 trucks and tractors and lease them to small business and large enterprises throughout USA. So the direct lease, they are not the manufacturer, but they are the specialized company who purchased the asset to give them lease to the third party. Number 3 is the sale and leaseback, so which describe also a type of lease in which a firm already owns the asset. It will prefer to lease them for some particular reason. For example, if the firm is having some financial difficulties, so the firm receives cash from sale of the assets and then make the lease payment to retain to use the asset. The example is the RMIT University Burke Street building. RMIT University sold its Burke Street building a few years back, around 2012 and 13, and subsequently leased it back. The another type of lease is the leverage lease. A leverage lease is a lease in which the leaser borrows from the bank or other lenders to obtain the initial capital to purchase an asset, using the lease payment to pay the interest and principal on the loan. Number 5 is special purpose entity or SPE lease. So a special purpose entity or SPE lease is a separate business partnership created by the lessee for the sole purpose of obtaining a lease. So, for example, the asset need a large amount of money. For example, the company is purchasing an aircraft or a Boeing aircraft, which need a substantial amount of money. So in that case, the special purpose entity can be created by the lessee for the sole purpose of obtaining a lease. And this business partnership can be, the contract can be done with the financial institution. So there could be a large number of financial institutions who would like to come with a partnership with the lessee in order to provide them the lease. Number 6 is the synthetic lease. Synthetic lease, a lease commonly used for a SPE, and it is designed to obtain specific accounting and the tax treatment. Now we need to also understand that the residual value of an asset is also an important factor for the lease financing. So the residual value is an asset's market value at the end of a lease. The cost of the lease will depend on the asset's residual value. So in this slide, we'll talk about the lease payment and the residual value. For example, assume your business needs a new $20,000 forklift and you are considering a lease for the forklift for the 4 years. The estimated residual value of the forklift in 4 years is $6,000. If lease payment are the amount of L are made monthly, then the lessor cash flows from the transaction are the following. So if you look at here, the purchase price, which is time T, is 0, is negative $20,000 because they need $20,000 to purchase the forklift, and then there are about 48 payments. And at the end of the 48 payment, there will be a residual value of $6,000 of the machine. So this is the value of the machine at the end of the lease contract. So generally, we know the lease payment that typically made at the beginning of each payment period. So the payment will start from period 0, which is from here, and then there are about another 47 payments. So in the lease payment, the payment start from the beginning of the month, and then there will be another 47 payment at the beginning of the next month. So at the beginning, which is period 0, there will be one payment, and there are 47 payment left. So which is 47 plus 1 is the 48 payment. So let's look at an example. In a perfect market, the cost of lease is equivalent to the cost of purchasing and reselling an asset. So in the perfect capital market, the present value of lease payment would be equivalent of the purchase price minus the present value of the residual value. So let's look at this example. This will make our idea very clear. Suppose the purchase price of the forklift is $20,000. Its residual value in 4 years is certain to be $6,000, and there is no risk that the lessee will default on the lease. If the risk-free interest rate is 6% APR with the monthly compounding, what would be the monthly lease payments for a 4 years lease in perfect capital market? So we know the purchase price of the forklift is $20,000, and there is no risk of default for the lease. The residual value for the asset is $6,000 at the end of the 4th year time. So we need to calculate the monthly lease payment. So as we know, it's mentioning here that the present value of the lease payment should be equivalent to the purchase price minus the present value of the lease payment. So first of all, we need to calculate what is the interest rate because it's monthly compounding. So 6% interest rate divided by 12 is 0.05% per month. It's the interest rate. And in this formula showing the present value of the lease payment is equivalent to 20,000, which is the current purchase price, minus 6,000, because the 6,000 is the resale value at the end of the lease contract, divided by 1 plus 0.005 power 48. Now 1.005 is 1 plus the interest rate in decimal place power the number of months remaining for the payment. As we know, the lease payment is for 4 years, so 4 multiplied 12 is 48. So if we do the calculation, you will find the present value of the lease payment is 15,277.41 cents. Now we put these numbers in here, and then according to the formula we just calculate it, so which is L multiplied 1 divided by 0.005, which is the interest rate, multiply 1 minus 1 divided by 1.005 power 47. Why 47? Because there is a 1 payment in here, and then there are 47 payment left. As we know, at the lease payment there are 1 payment at the beginning of the month, and there are 47 payments remaining, which will be also paying at the beginning of the month. So if we solve this equation, we will find that the monthly payment is $357.01 per month. Hopefully you understand this calculation. Now let's look to another example. Assume the purchase price of an industrial latte is $50,000. The residual value in 5 years will be $10,000. There is no risk that the lessee will default on the lease. If the risk-free interest rate is 4.8% APR with the monthly compounding, what would be the monthly lease payment for a 5 years lease in a property capital market? So if we use the calculator, so in our calculation, we use the calculator Sharp ELS 735. Just make sure you are using the same calculator or an equivalent calculator for this, and then you can do the calculation. So the present value of the lease payment we need to calculate is 50,000 minus 10,000 divided by 1 plus 0.048 divided by 12, then power 60. Power 60 is coming from, because it's a monthly compounding payment for 5 years, it's 12 multiplied by 5 is 60. 0.48 divided by 12 is the interest rate, because as we know, the interest rate is 4.8%, and it's monthly compounding, so divided by 12. Then we can get the lease payments present value, which is $42,130. Now remember that we need to make sure the calculator is on the beginning mode, which is PGE or BEG, whatever, depending on your calculator. So you make sure that you press the beginning mode. When the calculator mode is set, then you put in the calculator that 12th period, or you just put it like this way. So there are it's monthly compounding for 12 years, so 12th month. Then n is 60, because n number of period is 60. Interest rate 4.8, it should be divided by 12. Present value is 42,130. That's how we calculate it in here, which is the present value of the lease payment. And then we need to calculate the PMT, which is the payment. And if you do all these steps, you'll find the monthly payment is $788. The reason it's showing negative because this is going out of your pocket. But that's how you need to pay from your pocket. So it's a negative. Hopefully you understand this calculation as well. Now we need to understand which is better, lease versus a loan. Now as an alternative, you could obtain a 4-year loan for the purchase price and buy the forklift outright. So that's another option. So if M is the monthly payment for the fully amortizing loan, the lender's cash flow will be the following. So if you go back to the previous example, not the alternative example, but the previous example, which suggests that the lease payment is for 4 years, which is 48 period. Now instead of taking the lease, if you go to buy the asset, so what are the differences? So to purchase the asset, the purchase price, it will be $20,000 at the beginning of the month, and then there will be 48 payments, which will be at the end of the month. Now there are two big differences. One is at the mortgage you pay at the end of the month, so there will be 48 payment, and at the lease you pay at the beginning of the month. So there are at the beginning one payment, and then there are remaining 47 payments. So still we're doing the lease versus loan, the comparison. So with standard loan, the entire cost of the asset is financed. With the lease, only the cost of the economic depreciation of the asset during the term of the lease is financed. So in the lease, the cost of economic depreciation of the asset is only calculated. Therefore, the lease payment is basically a bit lower than the mortgage payment. So the present value of the loan payment should be equivalent to the purchase price in the perfect capital market. So let's look into this example. Suppose that you purchase the forklift for $20,000 by borrowing the purchase price using 4 years annuity loan. What would be the monthly loan payment be in a perfect capital market where the risk-free interest rate is 6% APR with monthly compounding, assuming no interest on default? How does this compare with the lease payment of example, the previous one? So let's look into the monthly mortgage payment calculation. So if you use the calculator, you can find it out, which is $469.70 per month. Now if you do the calculation using the formula, so let's look at the formula. The monthly payment should be, the purchase price is $20,000, 1 divided by 0.005. 0.005 is coming from 6% APR, because 6% is the annual interest rate divided by 12, which is the monthly interest rate. So monthly payment 1 plus 1 divided by 1.005 multiplied by 48. The 48 is coming from 4 years multiplied by 12 months. So if you solve this equation, which is 469.70 per month. So if you compare it, lease versus the loan, so the loan payment is 469.70 per month, whereas the lease payment was previously $357.01. So we can see here that the lease payment is much cheaper than the purchase option. So by the law of one price in a perfect market, the cost of leasing and then purchasing the asset is equivalent to the cost of borrowing to purchase the asset. So the present value of the lease payment plus present value of the residual value is equivalent to the present value of the loan payment, and that's why at the loan payment you are paying higher amount per month. So the lease option. So in this slide we'll talk about the different types of the lease option and of the term lease option that are available for the leasing. Number one is the fair market value lease. So this is a type of lease that gives the leasee the option to purchase the asset at the fair market value at the termination of the lease. With perfect capital market, there is no difference between the fair market value lease and the lease in which the assets are retained by the leaser. So in the fair market value lease, at the end of the lease payment, the leasee will have the option to purchase the asset with the fair market value. So the leasee needs to find out what is the fair market value of that particular asset, and then he needs to pay that amount to the leaser in order to obtain the asset. The second one is one-out lease. So this is a type of lease in which the ownership of the asset transferred to the lessee at the end of the lease for a nominal cost of $1. Since the lease has effectively purchased the asset by making the lease payment, this type of lease is in many ways equivalent to the financing the asset with the standard loan, because by paying $1, the ownership of the asset will transfer from lessee to the lessor, so it is something very equivalent to the loan. So it's also known as the finance lease. The next type of lease is called the fixed price lease. So the fixed price lease is a type of lease in which the lessee has the option to purchase the asset at the end of the lease for a fixed price that is set up upfront in the lease contract. And this type of lease is very common for consumer leases, and since the lessee has an option to purchase, the lessor generally set a higher lease rate to compensate for the value of this option for that particular asset. The next option is called the fair market value cap lease. So this is a type of lease in which the lessee can purchase the asset at the minimum of its fair market value and a fixed price or the cap. So it's very similar to the fixed price lease, although the option is easier to exercise because the lessee does not have to find a similar asset elsewhere to buy when the fixed price exceeds the market value. So these are the different types of lease options that are available for the lessee. In this slide, there is an example about the lease payment and the end of lease options. So compute the lease payment for the forklift lease for the previous example. 1. If the lease is a fair market value lease. B. A $1 out lease. C. Fixed price lease that allows the lessee to buy the asset at the end of the lease for $4,000. So there are three options. 1 is the fair market value lease. Number 2 is $1 out lease, and 3 is fixed price lease with the purchase option of $4,000. So with the fair market value lease, the lease can buy the forklift for its fair market value of $6,000 at the end of the lease option. That's what we have done it before. So the lessor obtains the residual value of $6,000 either from the forklift itself or from the payment of the lessee. Thus the lease payment will unchanged from the previous example, which is $357 per month. So if you go back to the previous slide, you can find out the calculations, find that the lease payment is $357 per month. However, with the $1 out lease, the lessor receives the asset with no residual value, because with the $1, the ownership of the asset will be transferred to the lessee from the lessor. So in this case, the lease payment will be higher than the previous one. So the present value of the lease payment should be $20,000, not like the previously. So $20,000, and then you put the other information in this calculation, and then you'll find the payment is $467.36 per month. So this one is much higher than the previous calculation, which is $357 per month, because here this is a fair market value lease where there are $6,000 residual value is available for the lessor. The next one is the fixed price lease. Because the forklift will be worth $6,000 for sustain, the lessee will exercise the option to purchase it for $4,000. As a result, the lessor will receive only $4,000 at the end of lease. For the lease to have the NPV of 0, the present value of the lease payment must be $20,000 minus $4,000 divided by 1.05 or 48, which is $16,851.61. Therefore, the lease payment should be, if you do the calculation, $393.79 per month. Correct? Because here is $16,851, because at the end of the lease payment, the residual value of the asset is 4,000, not 6,000. So if you compare the three, you'll find in the first example, at the fair market value lease, the monthly payment is $357. With $1 out lease, the monthly payment is $467.36. And the fixed price lease, where the residual value will be $4,000, the lease payment is $393.79 per month. So if you look into this example, you can understand that which is the better option for the leasing. So let's look at another example. The purchase price of an industrial lot is $50,000. The residual value is $10,000 at the end of the 5 year. There is no risk that the lessee will default on the lease. So if the market interest rate is 4.8% APR with the monthly compounding, what would be the monthly lease payment for a 5 years lease? And if the lease is $1 out lease. So if you use the calculator and you put it to the beginning mode, you put the 12-month period and then put N is 60, interest rate is 4.8 and it should be divided by 12. The present value of the lease, the present value of this lease is $50,000. And if you calculate the PMT, it would be 935.27. Hopefully you understand this calculation. So the other lease provisions. So there are different types of other provisions that might be included in the lease. For example, early cancellation option that allows the lessee to end the lease early, perhaps for a fee. 2 is the buyout option that allows the lessee to purchase the asset before the end of the lease term. And number 3 is the clauses may allow the lessee to trade in or to upgrade the equipment to a newer model at a certain point of the lease. For example, the universities are using all these computers or the desks are having a clause of upgrade this item. So these are the other lease provision. For the taxation purpose and for the legal consequences, the lease can be divided basically into two parts again, or the two different categories. One is called the operating lease. So in the operating lease, a type of lease viewed as a rental for the accounting purpose, in which the lessee reports the entire lease payment as an operating expenses. For example, the lessee does not deduct the depreciation expenses for the asset and does not report the asset or the lease payment as a liability on its balance sheet. So the use basically the cost of the lease or the monthly lease payment as an operating expenses. Operating lease are disclosed in the footnote for the lessee financial statement. The second types of the lease for the taxation purpose or the legal consequences is called the capital lease. So the capital lease is a long-term lease contract that obligate the firm to make the regular lease payment in exchange for the use of an asset. For the accounting purpose, it viewed as an acquisition for the accounting purpose, and the lessee lists the asset on its balance sheet and incurs the depreciation expenses. The lessee also lists the present value of the future lease payment as a liability and deduct the interest portion of the lease payment as an interest expenses. So this is basically known also as the finance lease. So let's look what really happens in the operating lease and the capital lease. So in this example, the Harbor Cruise Lines currently has the following balance sheet in $1 million. So cash 100, property, plant and equipment 1,500. So the total asset is 1,600. And the liability includes debt is 900 and the equity is 700. So the debt plus the equity is 1,600 as well. So Harbor is about to add a new fleet of cruise ships. The price of the fleet is $400 million. What will be the Harbor's balance sheet looks like? if A. It purchased the fleet borrowing $400 million. B. If acquired the fleet through a $400 million capital lease. C. It acquires the fleet through an operating lease. So we'll look at how this situation or options will impact its balance sheet. For the first one, part A and part B, the balance sheet consequences are the same. The fleet became a new asset for the firm, and the $400 million become an additional liability. So for the option number 1 and 2, it became the asset of the company because it's a capital lease. So the cash, it remained 100, but the property, plant and equipment became 1900. Previously it was 1500 plus 400 is 1900. At the liability side, the debt is 1300. However, previously the debt was 900, so 900 plus 400, the new fleet of ships is $1,300. The equity remains the same, 700. So the total debt plus equity is $2,000. Note that the firm's debt and liability ratio increased in this case from 1.29 to 1.86. If the fleet acquired through the operating lease, as described in part C, there is no changes in the original balance sheet. So if the company decided to go for the operating lease, so there will be no changes in the balance sheet because it's using the lease payment as an operating expenses. And the new fleet of ship, it does not include in the balance sheet as an asset. So for the accounting purpose, the balance sheet, it remains the same. In the lease accounting, a lease is treated as a capital lease for the lessee and must be listed on the firm's balance sheet if it satisfies any of the following 4 options. Number 1, the title of the property transfers to the lessee at the end of the lease term. Number 2, the lease contains an option to purchase the asset at the bargain price, and that is substantially less than the fair market value. Number 3, the lease term is 75% or more of the estimated economic life of the asset. And number 4, the present value of the minimum lease payment at the start of the lease is 90% or more of the asset's fair market value. So let's look to an example. The problem is, consider a 7 years fair market value lease for $12.5 million. The Gulfstream jet with the remaining useful life of 10 years. Suppose the monthly lease payment are $175,000 and the appropriate discount rate is 6% APR with monthly compounding. Would this lease be classified as an operating lease or capital lease for the lessee? What if the lease contract gives the lessee an option to cancel the contract after 5 years? If you go to the next slide, you can look at the calculation. To compute the present value of the monthly lease payment at the beginning of the lease using the annuity formula, the monthly interest rate is 6 divided by 12, which is 0.5%, and it's after 7 years, it will be 12 monthly compounding. So 12 multiplied 7 is 83 monthly payment after the initial payment. So if you calculate the present the value of the lease payment, if you use the formula, we'll find out that it's 12.04. Now we go back to check these options. So as we know, if the lease contract fulfill any of the 4 conditions, then it will be treated as a capital lease. Otherwise, it will be treated as an operating lease. So the present value of the lease payment is 12.04. The actual price of the asset is 12.05 million. So because the present value of the lease payment is more than 96.3% of the actual value of the jet, it satisfies condition 4 and it is a capital lease. If the lease can cancel the contract after 5 years, the minimum number of lease payment in that case, it will be 60 under the contract. And if you do the calculation again, you will find that the present value of the lease payment would be 9.1 million. So in that case, it's only actually paying 73% of the actual value of the jet. So it is not fulfilling any conditions of the capital lease, and therefore it will be treated as the operating lease. Lease and bankruptcy. The treatment of the lease property in the bankruptcy will depends on whether the lease is classified as a security interest or the true lease by the bankruptcy judge. Now, what is a security interest? So, a classification of a lease in the bankruptcy proceeding that assume a firm has an effective ownership of an asset and the asset is protected against the seizure. So what is a true lease? The true lease is a classification of a lease in bankruptcy proceeding in which the lessor retains the ownership rights over the asset. So within the 120 days of the filing chapter number 11, which is bankruptcy, the bankrupt firm must choose whether to assume or reject the lease. So how it will be done? So if it's assumed the lease, it must settle all pending claims and continue to make all promised lease payment. So they want to make sure that it is a lease, so they need to continue with the lease payment. If it rejects the lease, the asset must be returned to the lessor. Hopefully you understand this part as well. And there are valid arguments for the leasing. As we know, the lease financing, the asset remain with the owner of the asset, which is the lessor, and there are some conditions. If the conditions are met, then it can be treated as a capital lease or it will be the operating lease. And within the contract, there could be different provisions which can actually determine who will retain the ownership of the asset. However, there are different arguments as well for the lease payment and the lease financing. One is the tax differences. Second is the reduce the resale cost. 3. Effective gain from specialization. 4. Reduce distress cost and increase debt capability. 5. Transferring the risk. 6. Improve incentives. 7. Avoiding capital expenditure controls. Number 8. Preserving capital. And number 9. Reducing leverage through off-balance sheet financing. These are the valid arguments for the lease. Hopefully you like this lecture. Thank you very much for watching my video, and if you like it, do not forget to subscribe my channel. Thank you.